This video will give you a demonstration of a class exercise, which is about project finance under the big theme of DCF model. Now, this is a model of DCF, and we have the pro forma statement here. And we learned that to make the balance sheet balance, we need to have plug either equals to cash, debt, or stock. Now, if the plug equals to cash, meaning that we need to determine the policy for debt and stock. And you know that debt and stock, these are the two ways to fund the project or to fund the growth of the assets, where the firm will get the access to the capital. So what we have here is we have this project finance problem. So it can be a firm, it can be just a project. Now let's just think it as a project, and we want to know the cash flow of this project generated in the future, and we want to evaluate whether it's worth to invest it. Now the firm will borrow money in order to finance a project, and the project is set up in year 0, where the firm will have assets equals to 2,200, and these 2,200 is financed by debt and also stock. So $1,000 is supported by the debt issued, and 1,100 is supported by the equity issued. So there are some borrowing conditions here. So we have the requirement here that debt must be paid off in equal installments of principal over the next 5 years. So now first, let's start with the simplest step, which is incorporating the debt condition or the borrowing conditions here. So our total amount of debt is 1,000, and we want to pay off all of these 1,000 equally. So we're going to spread out the payment evenly in future 5 years. So that will be 1,000 equals 1,000 divided by 5. And I want to fix it. However, if you notice that this is the amount that will be paid for the bond investors. And here we are keeping the book of the company or of this project. So it should be the remaining amount. So therefore, the remaining amount is the book value of the debt subtracting the amounts that has been paid off in year 1. And I want the annual payment to be fixed. So that's why I'm fixing B35 here as the numerator. So every year, this project will pay $200 back to the bond investors. And this one will be moving because this one will represent the ending balance of the previous year. Now I can just drag it over. So you can see that at the end of the 5th year, the debt is completely paid off. So that fulfills the first condition here. And then how about our policy for the stock? Now, the policy of the stock is straightforward, that the firm is not allowed to issue any new equity. So meaning that the equity level will just equals to the previous level. Drag it over. And let's just go back to the second one. We haven't incorporated the second condition here. Until the debt is paid off, the company is not allowed to pay dividend. Now, therefore, we know that given the first condition, the debt will not be paid off until the 5th year. So here, meaning that the dividend will be essentially 0 for all of these 5 years. And remember, I mentioned that we don't want to hard code. So we just put the assumption here, dividend payout ratio equals to 0. And the dividend is therefore profit after tax times dividend payout. And we want to fix it. F4. Enter, drag it over. So condition 1 is done, condition 2 is done, condition 3 is done. Now let's look at the way to model net fixed asset here. In the previous model here, our assumption for net fixed assets is our net fixed asset over sales, and it is kind of proportional to the sales every year. So net fixed assets is actually growing. Now, if net fixed asset is growing, it means that the company's depreciation has economic meaning that the company wants to expand their asset base. So that means net fixed assets is a function of sales, such that those assets can support the sales. So here, when net fixed asset equals to constant, let's see what happened. I'll go back here and here. And since we have determined the policy for debt and stock, we can therefore enter the formula for cash, and cash is a plug. So that means we want cash equals to this side of the balance sheet. So cash is on the asset side. So we want it to equals to the liability and equity side, total number here, subtracting each individual asset, each individual items under the total asset side, subtracting current assets, subtracting net fixed asset. You know that this is not a final answer, and I kind of like discussed it in the previous lecture that this is a circular argument. You need multiple equations to be inputted such that Excel will output multiple outcomes together. So it's a system of equations, and the output will be multiple variable. So fixed asset model, we have net fixed asset, which is a constant. So it will be just keeping the same level here, drag it all the way over. And then depreciation is just the accumulated depreciation. So the depreciation from previous years plus the depreciation this year, drag it all the way over. And here, the fixed asset at cost will be the sum of these two. So the fixed asset will be equals net fixed asset, adding the depreciation. So since depreciation is negative, so it will be subtracting the negative depreciation. So drag it all the way here. Now, fixed asset at cost is the book value of all the fixed asset. Subtracting the depreciation, we have the net fixed asset here. And finally, total assets should be cash plus current assets plus net fixed asset. All right, then let me explain what does the model of fixed asset mean here. So we are applying the third model of fixed asset here, which we set net fixed asset equals to constant. Now it equals to constant, meaning that the depreciation amount every year here equals exactly to the capital expenditure, so which will be the increase of the fixed asset at cost. So therefore, you see that the fixed asset at cost is expanding year over year, meaning that the company, or for this project, it is buying more fixed asset every year. And the incremental amount from year 1 to year 2 will be exactly the amounts that has been depreciated here. So therefore, in this case, it means that this project has an asset base that usually is properly managed. And this meaning that, and also the increase here can support reasonable future levels of sales. So the amount that has been depreciated is exactly the same as the amount that is needed for support the same level of growth, sales growth. And how to see that the depreciation equals to capital investment. Now, the CAPEX is basically here, increasing fixed asset at cost. So it will be equaling to the increase of the growth of fixed asset at cost. And we want to subtract this from the calculation of free cash flow because we think this is an expenditure. So we're going to put a minus sign here. Drag it all the way here. So this will be the increase in fixed asset at cost. And you can see that that is exactly the same as the amount that has been depreciated every year. And I now can kind of calculate the free cash flow based on our previous formula. This is equals to profit after tax. And here, add the depreciation back. Depreciation is a negative value, so I need to add a minus sign so that it can be an addition. Subtract increase in current assets equals to the incremental part of current assets, which will be this year's current assets minus last year's current asset. And we want to subtract it because we think that increasing current assets also have the capability of generating sales. So it's a kind of like an expenditure. So subtract it. So it's a positive number here. Let me just check. Yes, there's a decrease in current assets, so we treat it as a positive number. Okay, so that makes sense. If usually it's increased, so it's usually it's going to be a negative number. And add back the current liability, and we think that the current liability is sales related. So if we have a current liability, that means we have something more to be collected. Here, that means that we have some more cash. So it equals to current liability 92 subtracts the previous level. And we are adding it back, so we don't need to do anything here. And add back after-tax interest on debt. So we want to exclude the financial activity. So any income generated from the debt will be added back. However, the tax payment paid is something that is gone and paid like an expense. So that's why we want to do the after-tax adjustment. So the interest on debt will be here. So we want to add it back, and we only want to add proportional back. So it's the proportion that subtracting the tax payment related to it. Enter. So since we want to add it back, it's negative value here since this is negative. And subtract after tax interest on cash and marketable security. So it should be interest on cash and marketable security times 1 minus the interest rate here. And this is a positive number, and we want to subtract it. So here we have income generated from investment on cash and marketable security, probably generated from money market fund. And this source of income is not really related to our operating activities. So that's why we want to subtract it from profit after tax. And tax is an expenditure, and it's cash expenditure. So we can't add the tax part back. So we have to exclude the tax effect here. So we do the after tax adjustment. So finally, the free cash flow will be the sum of all the previous item. And I'll be just dragging it all the way over. Okay, so there is an error here. It should be a tax adjustment. So I need to move this to tax rate here. Now this one looks better. So equity cash flow will be therefore, for calculating ROE, the level of stock issuance, retained earnings, plus dividend. So this represents the part that belongs to the equity investors or shareholders. So we shouldn't include the debt here. Internal rate of return will be the break-even point where these cash flow, the interest rate that makes this cash flow, the net present value of this cash flow equals to 0. So what will be the rate of return that makes this, the net present value of this equals to 0. So it equals to IRR So return on equity will be 20%. So the calculation of return on equity is related to the calculation of the pro forma model here, relating to the retained earnings, stock, dividend payment. And retained earnings is related to the retained earnings here in the income statement and the previous level. And the retained earnings is related to all the above item here. So we want to know the sensitivity of ROE as a function of initial equity investment. So we want to see that if we change the amount here, so this amount here for the initial equity investment, 1,100, what would be the effect on the return on equity? So it will be data, what if analysis, data table. Column input will be the initial equity investment for calculating 20.32%, which is here. Click OK. And then refresh it. And now we can see that as we increase the initial equity investment from 0 all the way to 2,000, the return on equity will decrease. And this actually makes perfect sense because the use of capital from the equity market will be more efficient if we get this economy of scale.